Thank you for coming. I'm Herb Fockler. I'm one of the partners at Wilson Sonsini Goodrich Rosati in the business law department. And as you know by now, I see very many familiar faces. Thank you very much for coming repeatedly. But Wilson Sonsini is delighted to be a co-sponsor with Wharton San Francisco campus of these sessions for entrepreneurs. This is the 21st one we've done, and it's always been fun for me. I hope that you are getting a lot of value out of these sessions. I put up here that we're going on hiatus for the summer, and that's actually not correct. We're going to have one more session on June 15th, and it will be here. Up here, I think it's going to be in life sciences. We're pulling it together right now, and you'll get the normal invitation by email sometime very soon. Please come join us for that. And then we will go on hiatus for the summer, and then we'll pick it up again in the fall. Please let us know if you have ideas about what you'd like to see sessions on. Or different types of speakers or anything like that, more lawyers, less lawyers, whichever you want in that area, or more VCs or more entrepreneurs with war stories. So we'd like to keep this fresh and interesting for all of you. So let us know what you'd like to see. I'll also remind you that you can find the previous tutorials by going to tinyurl.com and then /web workshops. You can find a lot of them. You can also just go to YouTube, and if you put in Wharton, I know if you put in Wharton in my name, my previous presentation will come up immediately. And it's Herb Fockler. It's not the guy who's doing something stupid with a beer can on the bus, you know. At least I don't think it's me. But a lot of these are online on all sorts of subjects. So please use those. Please tell your friends. We hope it's a very valuable resource for people. Also today, just out in our internet audience, we're webcasting. If you can see your screen now, there's a spot there to click on the screen that you have, a little sort of word balloon. Please click that, and you can ask questions. They'll be relayed to the room here. And then I encourage all of you to ask questions too. Let's try to make this interactive. There's a lot of stuff going on in the whole area of early stage funding right now. Differences from the model that was in place for many years. I've been doing this for almost 28 years, and I won't mention how many years Doug has been doing this. But there's been a lot of change and evolving of how funding is done, especially at the early stage in the past couple of years. So I'd like to hear from you. What are you seeing? And maybe make this a dialogue more than a lecture. Also, finally, I'll be staying around afterwards the way I normally do to continue discuss any of these discussions if you want to. I think we're in room 645, which is over by the elevator, and happy to talk and stay pretty much as long as anybody wants to talk about things if you don't have a day job to get to. So with that, normally I introduce the speaker, and now I get to introduce me. But why don't we get in? And I told you a little bit about myself. I'm in the business law department at Wilson Sonsini. I do the full range from entrepreneurs with gleams in their eyes, thinking about how should we form a company, what should we think about from a legal point of view, all the way through multi-billion-dollar public companies. I'll work on all of these in one day. It's a very interesting practice, but I will tell you that it's a lot more interesting sitting with an entrepreneur thinking about, how do we form this business, how do we make this work, and being a counselor on the business side than answering a question from a New York Stock Exchange listed company about, are the directors independent or are they not? Can you look in the rules? So the fun thing is doing the startup work. And I'll come back to that in a minute about what our firm offers for entrepreneurs and how we work with entrepreneurs. But let's get into today's topic. So current trends in angel and early stage venture capital financings. I'm going to cover kind of three main trends. One is there are a lot more ways to find investors now. There's more types of investors out there, and there's a real proliferation of ways to fund or people who are interested in funding. But it's still a challenge. It's still hard to do. It's not like it was in the late 90s where, at least the story was, you walked into a venture capitalist's office and you walked out with a check for $8 million 2 hours later. So at least I heard about that. Second trend we're going to talk about is simpler financing structures. These have been around for a while, but they're getting used a lot more now. Trying to conserve cash, conserve time and effort, to get through the financing documentation, so that entrepreneurs and their teams can concentrate on business rather than legal issues. But the exact terms that are in these deals can be very crucial still. And there may not be a lot of them. They may be simpler, but there's a lot that could bite you later on in those structures. And then finally, we're going to talk a little bit about innovative founder protections. I get a lot of questions about these. They're in the press a lot. I'll try to explain some of them. I'll give you some of my views on them and what I think is going on in the community about them. But I would say a lot of them are not for mortals like you and me. It's if you happen to be, say, Scott McNeely, formerly CEO of Sun, forming a new company, you can command some different terms than you can if you're a first-time entrepreneur starting things up. So let's talk first about finding investors. You've got a whole range now. You've got the traditional angel groups, and then you've got these new incubators. Incubators have been around for a while, but it seems to be a model that is working better now, and the incubators have gone from just here's some space, maybe we'll give you some help, we'll pay for the electricity, and like that, to really providing educational and mentoring much more. And also there's a cachet to being in a lot of these incubators. And they merge somewhat with super angels, so we'll talk about some of the major players there too. There's AngelList, which one of my partners described as the greatest innovation ever for early stage entrepreneurs looking to raise funding. There's crowdfunding. Because somebody's going to ask about it if I didn't mention it, I'll talk about that a little bit, but we could spend an entire session on crowdfunding, and it's probably premature to do that because even though it's in the new Jobs Act, the SEC has to promulgate some regulations, so we're not exactly sure how it's going to work. And then there's also early stage VCs. We're seeing the resurgence of VCs being interested at very, very early stages. And then even as we did in the last presentation, we're seeing investment banks even coming way down in early or way early in the cycle to talk to companies. So a lot, it used to be, you might have had just one of these on the list, the VCs, and then whether they were interested in early stage or not was, kind of an open question. Start with the traditional angel groups. I've listed, a couple of here. If you are affiliated with one that I didn't list, please don't be offended. I just happened to pull up some that came immediately to my mind, and then flipping through the, there's actually an angel. I think it's Angel is it Angel Capital Association or Angel Venture Association that lists all the angel groups. Just put angel group into Google, and you'll get a huge list of them all. And they, well, let's talk about some of them specifically. Band of Angels is one of the, probably the best known, at least around here, of the angel groups. They say they're Silicon Valley's oldest seed funding organization with 130 former execs from, you can see a number of very well-known companies that their execs come from. And they're the model of the angel group is that, rather than having angels, as individuals sourcing deals and doing one-on-one, you come on to monthly meetings, and they will select at least Band of Angels will select 3 companies to present at the meetings, and then hopefully the angels in the group will take it from there and develop relationships with the companies and maybe even invest. It is a pretty tight funnel. They say they get about 50, they screen about 50 plans a month, and that gets down to just 3 presenting. They didn't say on their website how many they actually fund. I think it's still a pretty tough thing. But you can also see does this work as a laser? I don't know. You can see I included a breakdown of the industries they're in, pretty spread among internet, other types of technology, and even a good amount of life sciences. Another one is Keiretsu Forum. They claim to be the largest angel network in the world. You can see at the bottom the list of all their organizations. Barcelona, Beijing, Paris. I want to join the Paris one. That's the one I want. Westlake Village. So they're all over the place. They're much larger, and they you can see 850 accredited investors. They tend to be a little bit more formal in how they operate, and they I think you have to pay a certain amount of money to present them, whereas some of the others you don't actually have to pay to present. Another one is Sandhill Angels. They happen to be one that we hear about a lot locally, and kind of the same model as Band of Angels. Although they don't invest individually, they invest as a single entity if enough of their angels are interested. Angels Forum is another one we've met with recently, in much smaller, 25 individuals, and they, reflecting the fact that it's not that many of them, they want to make sure that you're local. You have to be within 50 miles of Mountain View, California. Fair amount of life sciences there, too. So that's a rundown of just a couple of the angel groups. There's a lot more. But it at least provides some structure to getting in front of angels. A lot of questions we get from entrepreneurs is, well, how do I find angels? It's like, can you hook me up with some guys who will invest in my company? It's like, that's kind of hard to do a one-on-one thing out in the world. The angel groups do a organizational approach to that helps a lot. Then we've got the new incubators and the super angels here. This is sort of the interesting change. And back in the, as I said earlier, back in 10 years ago, or in the internet bubble, you had incubators that would provide you with water and power and office space and things like that, and take a big chunk of your stock, and not clear how much you got back from them. A lot of these groups, though, are they seem to come first with the educational thing. Weekly meetings over a number of months where you get information and mentoring, lecture sessions and all, and so there's a lot of value that you can get vary. They all do take some equity. Usually they take, let's say, maybe 5 to 10% of your initial stock, and they pay you somewhere in the $10,000 to $20,000 range for that position. And a lot of them also, you automatically, if you're selected to be part of them, and it's a very selective process, like with the angel groups. There's a very tight funnel there. If you do pass that muster and get to be in their group, you get automatically maybe $100,000, sometimes even up to $250,000 of investment capital, usually in the form of a convertible note. It varies among each of these groups exactly how much you have to do, but it's kind of sight unseen, that money that comes in, which is pretty nice. And then you get the cachet of saying you're one of these, you've been admitted to one of these groups. You had to.
Do you know, is there a convention among these incubators about what the pound of flesh is that they'll take in the form of equity? You say it's 5 to 10%. Is that like a convention, or is it vary dramatically?
It doesn't vary dramatically. I looked at some stats, and we see at Wilson Sonsini, we see a lot of deals, a lot of companies, and so I have access to a lot of information, a lot of which is not public. And I really didn't want to put up a slide that said, oh yeah, go to Y Combinator and this is the deal that you can get from them at that. So I'm being a little bit general here, but it seemed like 6% was sort of the sweet spot in most of them, 6 or 7%, although it varies a little bit with the number of founders. But, and I'm not tying this to Y Combinator, no, but if you think kind of 6% of your stock and maybe $10,000, $12,000, and then an extra $3,000 for each one of your founders. Now, why it's structured like that and the increase of the founders, I'm not really sure, but that seems to be fairly common. And then the dollar amounts of the convertible note were in the $100,000, $150,000 range. Anyway, let's talk about some of these specifically. Y Combinator is the most famous of them all. I mean, not to denigrate anybody, but if Band of Angels is the best known of the angel groups around here, Y Combinator is the best known of the incubators. They've been around for 7 years, and they funded over 300 companies. One interesting thing, again, this isn't specific to Y Combinator, we're waiting to see the really big hits come out of the incubators. There haven't been. It's a model that seems to be reasonably successful, and you can see they're in Dropbox, Airbnb, Heroku, some well-known ones, but it hasn't proven out completely as a great model yet. But it's early still. I mean, they only started in 2005. And if you get admitted to Y Combinator, then, okay, people are going to say, wow, that's, there must be something there. Techstars is almost as old. They actually, I think they started in Boulder. They do sessions around the country. I didn't mention, but Y Combinator does 2 sessions a year every 6 months or so. Techstars does 6 classes a year, but much smaller groupings each time. So there's kind of less mentoring there, or it's more concentrated in time. But they'll have sessions all around the country each year, and sometimes even 2 sessions in particular cities. 500 Startups, this is Dave McClure's group, and so you tap into some of the PayPal mafia and all there. That's formed much more recently, but he's gotten a lot of press just for being around so recently. He's actually got office space in Mountain View, and The Techstars does too. Y Combinator, I don't think does, and so with Techstars and 500 Startups and some of the other ones, part of the benefit you get is the educational sessions that they give you, the mentoring and everything like that. Part of it is also the hanging out space, just to see other entrepreneurs, to hang out after the sessions and talk and bounce ideas back and forth. And there's a tremendous amount of value in that. So that's another thing to look for in these groups. Do they have some space where you can interact with your fellow entrepreneurs? AngelPad, another one located up here. They've actually got space south of Market here. Slightly smaller than, say, Y Combinator, but they also do about every 6 months, I think. Who else I got? Oh, Founders Institute. This is, they take a much broader view. I mean, they are trying to do, entrepreneur education all over the world. You can look at some of these locations. I think they're in Jakarta, Hanoi, places like that. And they've done 400 companies. I think I'll be a little careful about, I don't know if that means that there's sort of a lower bar there, but still, you get a lot of benefit there. They're kind of more of a accelerator than an incubator, in that they're providing more educational stuff, but it works more for entrepreneurs who have day jobs and who are looking for guidance, but maybe not, a space to hang out for many, many hours or to get your company going. Their sessions are in the evening, and they tend to have, in their classes, they tend to have a large drop-off rate. Maybe it's because people are, have day jobs, and they also require you to actually incorporate your company, so that requires some outlay of cash that for people with day jobs they may not do. But they're Adeo Resi, the guy who's behind it, is also behind The Funded. Do you know that website? It's really worth checking out. It's entrepreneurs rating VCs. And, I mean, you could, I guess with any of these things like Travelocity, people who have an axe to grind may put in bad reviews, but you can look at general reputations of VCs. And if you're an entrepreneur, there's a more private area of The Funded that only entrepreneurs can see, and you get more information about people. Yeah. So
these incubators, is the mentoring purely on the business side, or is there also some framework for technology support or mentoring?
I think it varies. Oh, sorry. Yeah, the question was, with the incubators, is the mentoring just on the business side, or is it also on the technology side? Is it broader than just, how do you set up a company and get funding, I think. It varies from incubator to incubator, and it varies also with the particular mentors who they're bringing in and are available. My impression is it is broader than just the business stuff. You do get technical advice. Some of the people they bring in are entrepreneurs who've done this before or experts in particular areas. You probably won't get really hardcore technical help, but I think you get much more than just how do you do a business plan. Yeah.
So my own sense of this is that a 5 to 10% bite out of your equity is a lot of equity to take to pay for an incubator.
Yeah.
If you're accepted into it. Do you have an opinion if you're an entrepreneur and you're evaluating, should I go this alone and kind of figure out how to do this just by working with the people that I know, or should I join an incubator? And the objective is, I want to optimize for success. What's your view of that, Herb? Do you feel like there's a benefit to being joining an incubator or an accelerator? You'll have to repeat the question.
Yeah, so the question that Doug had was, what is my personal view about, the trade-off or the benefits of going with an incubator or an accelerator versus doing it yourself, because you do have to give up a chunk of your stock to get into these groups. I think a lot depends on you and what's your level of knowledge, what's your network, and also the idea and how attractive that is in terms of, can you do a lot of this on your own? Do you need a lot of the mentoring help? Or maybe you know that already. Do you need do you need the connections? Do you need a space to go where you can set up, temporary shop, and have meetings with investors, everything like that, or do you, or can you do it all, by yourself? From the outside, not being an entrepreneur, I think I'd try first going on my own. I mean, there is a lot of cachet, though, to say you're one of these companies, but it's also not guaranteed that it's not a golden ticket that you're definitely going to get full-blown funding beyond this. It's useful, but not certain. So I think I'd try. I'd try first on my own and see, and it may be a little bit self-fulfilling. If my idea isn't good enough to get this circle around me, then I might not be good enough to get into the incubators either. I definitely think that this is a better and more useful model of incubators than what there was 10, 15 years ago, where I think you paid an awful lot in terms of your stock just to get lights and some office space and a network. So, yeah, a question way back in the back.
Just to add to what Doug was saying,
Yeah.
These incubators usually, I suspect the median age of folks going in there are folks who are early on in their careers versus folks who have the typical Wharton executive profile, people who have 10 to 15 years of experience and who are trying to start something after that. Would you care to comment on that? Specifically because of that, I feel that the 6 to 10% is huge given the kind of return you get in return for that.
I'm sorry, you're thinking that most of the people going to the incubators are fairly junior, fairly young?
You look at Team Fellowship, you look at YC, most of those are folks who are fresh out of college.
Yeah, yeah.
And who are looking for a space to work out here,
Yeah.
trying to find other hackers who can sit and code with them.
Yeah.
Compared to folks who have had 10 years of work experience, you can go to Hacker Dojo or one of the places where you just get space, not necessarily
Yeah.
you have to give up equity for that.
Yeah.
And you raise money, friends and family on, and make do with that, and then go to the super angels or the VCs once you're ready
Yeah.
to actually do it.
Yeah, I mean, that sort of fits with what I'm thinking is that, these things may be very useful for people doing it for the first time and who, maybe coming out to Silicon Valley from another part of the country and don't have the network at all. If you've been in Silicon Valley for 10 or 15 years and worked with a number of companies, you have connections already that can get you straight to investors or how to, use the systems around here to get some office space without giving up any stock at all. I mean, it's also, the funnels on these things are, like I said, are very narrow, and it's tough to get in. They're not an incubator, but there is one super angel group where if you want to submit a business plan, actually most of the super angel groups, one of the things that we do at Wilson is forward business plans over to angels, angel groups, VCs for our clients to try to get a more warm referral. But a lot of the super angel groups, they really want everything to come through their web portals, their submission portals. And there's even one of them that in order to get to the part of their portal where you can submit your business plan, they have a quiz for you. And you have to solve this mathematical problem with, if you have a sphere of this size and then a circle and then a ratio and everything like that. And so if you pay me enough, I'll tell you what the answer is. I did figure it out. It doesn't take calculus. So, yeah, question over here.
If I may add, I mean, 3 years back when I was starting up my company, I was like, why should I give 10% or whatever to Y
Mhm.
Combinator kind of thing. But today, when I'm talking to entrepreneurs, I actually suggest that they should do that because today, Y Combinator gets you, money straight from Andreessen Horowitz. It gets you money from USD, and it also gives you a jump in your valuation just by being in Y Combinator from the PR and everything. That I think more than justifies the 6%.
Yeah, yeah. All right, so that's I don't disagree with that at all. I mean, that's the other argument. Yeah, and I mean, there's the cachet of being a part of Y Combinator, and for them, the loan that I said, you get whatever it is, $150,000 of invested capital. Some of it's coming from Andreessen Horowitz, some of it's coming from Ron Conway. So you're getting direct connections with those groups. So that's useful. But maybe we can talk some more in the after session about what people's experiences are with all of these. One more question, then I want to move on.
So with the YCs and the incubators, what sort of deals are you seeing the trends? Is it mostly consumer and mobile internet?
Yeah, I tried to list, let's see, up here the different, I guess I didn't list for them, the different areas. Some of these, well, maybe I didn't list it. A lot of it is consumer internet because it's very easy to do without a lot of funding. If you're going to, $100,000 is not going to get you very far if you're trying to do anything that's capital intensive. So, whereas you can get fairly far within a consumer internet company. I'll just touch. This is something more interesting for the lawyers and all, but there is a little funny thing about how you actually get the equity, or the incubators get their equity, because if they actually pay $15,000 for 6% of the company, that's going to imply a valuation for the company of I don't know, some in the hundreds of thousands, or a lot of money. And if you've got founders buying their stock at the same time, they don't have that cash to put in. So there are some games. I didn't say that. There are some interesting structures that are used to try to avoid cooking your common stock price too much, so you can still grant options at a cheap price to your employees and issue stock to other founders at a cheap price. Whether that works or not, these things are pretty new, and nothing that's really been tested that much. You hate to be the test case on any of these.
What's the difference between a convertible security and a convertible note?
Well, that's a very interesting question. This structure is used by 3 or 4 of the incubators, where you buy your stock, that 6% of the stock, at a very low price, the founder's price, and then you get this bizarre thing called a convertible security. It looks like a convertible note, but the idea is that the incubator will never convert it.
So it expires.
Well, it sort of hangs out there forever so that it looks like equity. They're trying to argue that it's equity and not debt. So it doesn't have like a term to pay it back or anything like that, but it hangs out there as being convertible. In the history of, I'm not aware of any of these securities that actually been converted. And if the company's successful, I guess people say, well, okay, even if somebody does convert it down the road, $15,000 of stock is, kind of who cares at that point. But that's sort of the, smart lawyers came up with that as a way to deal with this problem, and I don't know if the IRS would buy it at all. There's also Angel List.
Another question.
Yeah.
Have you ever seen, outside of discussion of incubators, have you ever seen any problems with, I don't know, I guess like 409A valuations or anything like that for early stage companies? Have you ever seen any circumstances where the IRS really cares?
All of us are very, so the question is about 409A valuations, and which are as an IRS code section that kind of mandates that you grant options at fair market value. And we could also spend an entire session on that too. I have not seen the IRS chasing people down for that, but it's fairly new still. We are all worried about it, and we are telling our clients, you really have to take this seriously. And the reason is the difference, what 409A does is it actually puts a pot of gold out there for the IRS to go after that might be worth it for them in a way that getting valuations wrong before 409A didn't. There wasn't a big pot of gold that they would get by being aggressive. So, but happy to talk to you further about that. So anyway, Angel List is, like I said, one of my partners says this is the greatest thing ever for entrepreneurs looking for funding. It's an online matching service, matching angels and companies. You put in your profile, and they also do a selection process to curate the list, and then their members, if a member likes you, then the member can introduce you around to other angels and all. But it doesn't have any of the mentoring characteristics at all. It's really just a way of exchanging or finding angels and getting into the network. So it's useful to poke around the website some, and I'm not doing it justice here in just one slide. So, yeah.
So what are the pitfalls about going out and raising money through the Angel List? Why wouldn't people do that instead of joining an incubator or going before an angel?
Well, you're not getting any of the mentoring that people want. It's more just a contact list. You do have to get a member to sponsor you and pick you up, and then refer you through other parts of Angel List. I mean, I think you mix and match a lot of these things. Do you have a question?
Yeah, Herb, we were advised not to list on Angel List until we were absolutely ready, and in fact, preferably already had our lead investor lined up. That 85% of the funding takes place within like the first 2 weeks of being listed,
Mm-hmm.
and then after that, you just kind of trail off. So if you're on that list and you've been on it a long time and you haven't gotten any funding.
So that's it. I mean, that's sort of the equivalent of being overshopped on Sand Hill Road. If you're up on Angel List and you've been up there too long, then nobody's going to pay attention to you anymore, and you're a shop deal. So I can see that. So that definitely. I mean, you're being very public about that you're looking for funding. Then I'll touch briefly on crowdfunding. In case you haven't heard of crowdfunding, it's raising capital, very modest amounts of capital, through many investments small investments by non-accredited investors. Trying to give the little people an opportunity to participate in the next Facebook. I'm very skeptical about this. I think it's going to be. I mean, if you want to make a lot of money if you want to spend, some of your money trying to win the lottery, then play the lottery. Maybe the results are a little bit better than the lottery. I don't do either. I think there's also a great potential here for a lot of, there's going to be some widow and orphan situation that's going to blow up under crowdfunding sometime in the next 5 years, and everyone's going to go, what were we doing allowing people to do this? Nonetheless, the Jobs Act does authorize this and mandates that the SEC is to create a special exemption to allow this to happen. Maximum of $1 million can be raised by an issuer, and then these limits on how much an individual can put into any company, which still seems awful high to me. 10% of your annual income or net worth. I mean, I guess if you have to be over $100,000 of annual income or net worth, but 10% into some little company that you probably don't know much about. I mean, there does have to be some public disclosure about the issuer, though not a lot, and it does have to go through a registered portal. But You know, the SEC hasn't published rules yet, and I think they put out a notice just last week saying, this isn't ready yet, don't do it. So, don't do it yet. So.
I assume that they get equity in the company then, but how is the company valued?
Well, we're all trying to figure it out. So I think it's probably a market structure. You know, it depends on how the people, the intermediaries are going to set up their portals and all. But probably a bid and ask type thing, or maybe it's just the company puts out there it's going to be, assigns the value and then sees what's happened. And so part of the reason I put up one slide, and I don't want to spend a lot more time, is that we just don't know how it's going to really play out. So,
So if I'm a founder and I've got a choice of raising money from 15 angels or 15 accredited investors off an angel list or 15 people through crowdfunding, you know, why do I care? The money's green, and at this stage of the company, I'm not looking for high-level business acumen from Sequoia Capital. I'm just looking for basic seed capital to turn on the lights and get me a place where I can work on my computer. So, I mean, how do you think about these, assuming all three alternatives are available, angels, accredited investors through angel list and crowdfunding, how do you parse those? What do you think about those?
okay, so Doug's asking my views about, you know, looking at the three, the angel groups, the angels and the incubators, the one hand angels list, and then crowdfunding. First off, I would not do crowdfunding. I do think that's going to blow up. I think you're not going to get very sophisticated investors. You're going to get lawyers, doctors, and airline pilots, or I don't know if airline pilots and doctors still make much money. The lawyers, well, forget them. But that's sort of the derogatory terms we use for, yeah, their money's green, but you know, it's probably dumb money that comes along. And I think even at that stage, I'd take issue with what you're saying. I think, you know, the more you can get smarts that go along with the money that's coming in, the better. You can always use more advice and more networks and more contacts. You're not going to get that from somebody who's just putting in $10,000 or $5,000. So in all of these, I would try to go for a smaller number of investors putting in larger amounts of money. They're also going to care more if they've got $100,000 or $200,000 invested in you than if they're basically buying lottery tickets. I think we talked a minute ago about the downsides of angel list. You know, if I had to choose among the three of those, I'd probably I think about, well, I'd still first try to do it on my own with my own connections if I had good connections. If that didn't work, I think I might go to the incubators next, mainly for the connections there. So, yeah, question right here. No, you guys Rochambeau for it. Who's going to go first?
So, question, when you talk about crowdfunding, I just assumed you were referring to Kickstarter. So, with Kickstarter, in many cases, people are actually buying a product. Like Pebble just raised, $8 to $10 million selling a watch before it was built. So, do you put that in that category? Because there's no equity in that.
Yeah. I mean, there's a million things that are covered under crowdfunding here and Kickstarter. And I talked to a fellow earlier this week who's wants to form a company to take advantage of the new flexibility under the rules. I guess I'd like to do another session on that once we know how things are going to develop there. There are a lot of people who are trying to do something here. Up until the Jobs Act, when they'd come in and talk to us, we'd sort of go, really? You really want to do that? And I hope you have somebody smarter than me advising you on broker-dealer regulation and stuff like that, because I just still do believe that it's one widow and orphan away from blowing up. So anyway, let's move on. Happy to talk more about crowdfunding later, but let's go to the second trend: simpler financing structures. What we're trying to avoid is the full-blown Series A preferred stock financing that's been used by investors venture capital investors for many, many years before I started here. Why it's the way it is, who knows? It's back in the midst of time, was developed as to how you do a first round Series A investment and all the documents and all the rights and all the formulas. It takes a lot of paper. It's probably about 5 or 6 different documents, agreements, and then a lot of little single-page things. And it's the term sheets go on for 4 or 5 pages with all the rights, a lot of complexities. You end up paying the lawyers a fair amount of money for it. It may not make sense when you're trying to raise $250,000. You know, if you're going to, typical lawyer, company side lawyers' fees for a full-blown Series A financing are somewhere in the $40,000 to $60,000 range, and then you also end up paying investors' counsel, which is probably $25,000 to $35,000. So probably somewhere in the range, coming up near $100,000, goes out immediately to pay the legal fees for doing this. And if you're raising $250,000, that doesn't make any sense at all. So one of the structures is the convertible debt deal, and we'll talk a lot in detail about that. It's our estimate around here is about 80% of very early stage companies go the convertible debt route. And so it's really prevalent, although some investors and angel group is on the record of saying that going to equity immediately is preferable. But I would definitely think about it sort of in the up to $1 million and maybe even a little bit beyond that, just because it's faster and more efficient. Yeah. Question?
Are people able to raise equity financing at a lower cost, just using like standard NVCA term sheet with minor tweaks?
We'll come. Well, there it is. Simple equity finance. The question was, are people able to raise money with simpler equity deals too for less cost? And yeah, that's the term that seems to be used now is Series Seed, which is sort of a Series A preferred stock deal light. And we'll get into a minute in the differences. I put down $500,000 here as a minimum. Now I'm thinking that's a little bit low. Although you can do it for less legal expenses than what I thought about, what I mentioned earlier. I would say, you mentioned the NVCA forms. Those are not simple forms. Those are detailed, complex things. There's lots of choices in them in different areas. And as Doug is just saying, my experience is you'll get 4 choices in a provision. 2 of them will be ridiculously investor favorable, and I've never seen them, and I, rejected out of hand. 1 of them will be somewhat investor favorable, but I won't like it, and then there'll be 1 choice that's what we would see as normal for Silicon Valley and out here. So we're on.
I meant more like a template that you can just put in and maybe simpler.
I mean, how do you? It's not simple because you've still got these 20-page agreements with 4 different clauses and footnotes explaining each, and so NVCA's not simple. But, well, I'll come back to it in a minute. Let's talk about why would you go one way and why would you go the other way with debt and equity. And by equity here, I mean the Series Seed, not full-blown Series A. So the debt is simpler documents, maybe about 5 pages for the note. Maybe you have a purchase agreement, maybe you don't even have one. It's faster because it's a lot simpler to draft 5 pages documents. We have forms. Somebody yesterday talking about it said, I can probably knock these documents out in half an hour. I wouldn't guarantee that, but it's not a lot for us to put these forms together. Obviously, that makes it cheaper, and you avoid questions of determining what's the current fair market value of your stock. Because once you determine the current fair market value of your stock, you're going to have to be granting options at that price because of a number of things, including the IRS code, or the Internal Revenue Code section 409A. and you want to sell high to investors. You want to sell low to your employees. If you're going to be selling to go to equity soon, that's going to drive your price either to the same price if you're selling common stock, or it's at least going to require some correlation between the preferred stock and the common stock. Also, you don't want to get into negotiations. I mean, how do you figure out how much a company is that's, been founded a month ago and, you're only raising $250,000? You really want to try to figure out what the value is? There are downsides, though, to the equity, one of the terms we'll talk about downsides to debt. One of the terms we'll talk about that we're seeing more and more in the debt is caps on the price at which the debt can convert into stock. And so you do have to have negotiations about what is that, because that's really a valuation of your company. What's the maximum valuation that of the company at which the stock will convert? That may also end up in worse economics for the company. I mean, you still are trying to guess what the valuation will be. Equity also allows the investors to get their capital gains holding periods running and also qualify for qualified small business stock, which at various times in the past couple of years has been zero tax if you meet all the requirements. And then there's also the question about, well, what happens if there's no conversion event for the convertible debt before it comes due? You're going to pay it back? It's probably not going to have enough money to pay it back. So you have to think about that failure scenario. Typical terms for the convertible debt: it's usually convertible into preferred stock into the first round, the Series A round at the time of the Series A. It's automatic. Investors don't have any choice. They are sort of taking on faith that it's going to be a normal Series A round, and they're going to take whatever terms are negotiated with the venture capitalists at that time. And usually there's a discount. In old days, there used to be warrants that went along with the loans, with the convertible debt, but now it's usually the conversion price is at a discount off of the Series A price.
So the discount is 10 to 20%, it's not 80% discount.
Right, sorry, yes, I got that wrong. It's a discount of 10 to 20%, and thus you're buying at 80 to 90%, somewhere in that range. So, nominal interest rate, nobody expects interest to be paid. It accrues, and then somehow it's dealt with at the time of conversion, usually converted into stock in addition. It's an incremental increase to the discount. Right now interest rates are ridiculously low. The IRS minimum rate, I think, is it's about maybe 0.2% or something like that to avoid imputed interest. So who cares? People aren't in this to get interest anyway. The notes are unsecured, no security interest. They're subordinated to any real debt, bank debt or anything like that. There's no financial covenants, no extra stuff going along. Again, there's no real expectation of repayment. You put any of that stuff in, you start to have to do more documents, you start to have to do more negotiations, the expenses going up. The whole idea of doing this is to be cheaper, faster, and avoid all of that. And the company does all the legwork. We are very good as lawyers. Part of what we do is not law. We organize financings for you. We know how to get them done so that you can make payroll next Friday. And we know how to call people up and get documents back and work through issues and do that very quickly. We don't have to do that. You can do that too as an entrepreneur or as a head of administration, VP finance, or whatever. But it takes more work. But there's a big difference between all the work that we normally do in a equity deal and just handing the company, here's the promissory note, Here's the questionnaire you use to make sure your investors are accredited and okay under the securities laws. You go out, get signatures, collect checks, send us copies so we have it for our records. So that's a big savings there on this. And I wouldn't, don't quote me on it, but you know, when I gave you numbers for a full-blown Series A earlier, 40 to 60,000, you know, this might be 5 or 10 legal fees, somewhere in that range. So, yeah, question?
Discount is only 10 to 20% off the Series A. It sounds like the scheme is not as attractive to the investor. Why would the investor just wait for Series A?
They're also looking for speed on this too, but that does lead to price caps. So, you know, the investors worry that if this is really a hot company, then even a 20% discount off of the Series A price may not adequately reward them for putting their money in early. So you are seeing more and more caps on caps on the valuation of the company at which the debt can convert, and sort of in the 3 million to 10 million range. Just looking at the math, you know, the price cap is a valuation of the company. You divide it by the fully diluted capitalization of the company, and you come up with what the conversion price is, or the cap on the conversion price. You do have to be very careful about what's included in the fully diluted capitalization. Do you include the options? Do you include the unallocated option pool? Do you include the debt? You know, people get into lots of arguments about that. There are arguments either way on whether they should be included or not.
Can I ask a question?
Yeah. Yeah.
So my sense is like 5 years ago, there was no such thing as a cap in the
Exactly.
note. And
Yeah.
now suddenly,
Yeah.
the pendulum has swung completely the other way, and it's like every convertible note structure that I've seen now has a cap to guard against that situation.
Yeah.
Where you've got lightning in a bottle. So
Yep.
is that weird? Is it a
Yes.
convention now?
Yes.
You should expect to see a cap in a convertible note.
You should expect to see a cap in a convertible note, certainly with any sophisticated or any of the groups we've talking about. One of them, I better not. I don't know if I can remember, and even then I would. One of the incubators, though, doesn't require caps in their notes, one of the ones that I listed. But most of them do. And I think, you know, our experience talking among the other lawyers is we see them in almost every deal. I mean, there is an alternative here that I just put up at the bottom where the discount rate increases over time. So you get additional amounts if the money's sitting in there for longer and longer. It's a little like, you know, the interest. I mean, the interest also functions that way. Yeah?
What rates are you seeing on these today? Is it 5%?
Yeah, probably somewhere in there. I mean, it's not the IRS rate, but people are not expecting to make money off of that. So 10 seems like it would be high to me. 5 is probably on the low side. Okay, there are complications here. You know, it's Marty mentioned. How's the debt treated when you calculate fully diluted? Is the debt part of the money or not? A part of the pre-money calculation or not? You also got an issue of an investor who's converting $1 million of debt at say an 80% rate with a 20% discount, so they're converting at 80%. They're going to get $1.25 million worth of Series A stock with a liquidation of preference of $1.25 million attached to that. If the company were to liquidate the next day, is that a windfall? You know, 10 years ago, people would have seen that and said, that's ridiculous. There's no way, the new investor coming in and say, there's no way that I want, you know, this guy to get $1.25 for every dollar that's put in, where I'm getting only $1 for every dollar that's put in. People seem to, you know, have gotten comfortable with that, probably because the alternative was using warrants, and those hang around and mess up your capital structure later on. But you can do a number of things like paying the liquidation preference in common stock. Sorry, not the liquidation preference, paying the discount, the conversion discount in common stock and things like that. You also have investors who say, well, I want to make sure that I get my pro rata share of the Series A round. It's like, okay, how are you going to calculate that where, you know, you're putting in debt and you don't have stock to say, well, what's your ownership interest in the company? I also think that, well, unless it's like 15 people that are unsophisticated investors, I think that, you know, you tell the investor the likelihood we're going to turn you down for putting more money in at the time of the Series A is pretty low. Other things, investors want assurance that no one will get a better deal. They want some sort of most favored nations clause. You won't give a different price cap for anyone else. Starting to get complicated. That's sort of an anti-dilution protection. Sometimes they want the company to treat the debt as equity so they can get their capital gains holding periods running. That means the company can't deduct the interest. I guess I don't care so much because it's not likely to be that much in the way of interest. But probably is equity anyway because nobody expects the money to get paid back. Other things, the investor wants information rights, board observer rights, you know, covenants limiting the company's actions, all sorts of other stuff. And at that point, well, why don't we just go to the Series C if they're going to ask for all that stuff? So, you also see some variations. You don't have to have all your price caps and all your convertible debt be the same. You can reward different timing or different contributions with different terms among the debt, which is really nice. With stock, you pretty much, if it's Series A, it's got the same terms for everybody who buys Series A stock. You know, you can differentiate in every different, with every different convertible note you issue. You also sometimes see these dances of they'll do a pre-convertible debt round before formal presentation to the angel groups, and then a less favorable to the investor deal as part of the formal presentation. Yeah, sometimes the companies will also grant some common stock at the same time to some of their investors to give them some extra equity. A lot of variations. I'd say none of these are really prevalent right now, but you might see them. So let's now go over to Series C, doing the stock deal. The term, at least, was invented by another Silicon Valley law firm. I didn't even know any other Silicon Valley law firms existed, but I guess they do. And it's been endorsed by a number of people. There's a version available at seriesc.com of simplified documents, so that's where I'd go to rather than NVCA. It's nothing fancy. We've got our own forms for it, and it's really just simplified Series A documents with no negotiations, no anti-dilution, no registration rights, no voting agreements, no co-sale agreements, no legal opinions. But beware that some investors will say, oh yeah, this is Series C, then they delivered the whole 5-10-page term sheet with all the normal terms in it, and it's really not going to be that much cheaper. And if you talk to any of the lawyers who are skilled in this area, they can look at the term sheet and tell you immediately whether it's really light or not. Just to give you an example of the differences, so in a Series A deal, you've got all of this stuff here on the left-hand side of the page, all those documents and agreements, and all the fees that I described at the bottom. In a Series C, you have a much shorter stock purchase agreement. You still have to do something to create the stock in your certificate of incorporation, but usually no anti-dilution protection, so that cuts out 6 or 8 pages. No investor rights agreement. There's probably a side letter that says if you grant investors any rights later on, then the Series C investors get the same ones, but that can be like a 1-page letter agreement. No voting agreements, no co-sale agreements, no legal opinions. Those are rather nice, and it's less, usually substantially less, but I don't know what the number would exactly be, but could be a lot less. So, third topic I wanted to cover is innovations and founder protections. And this is going to be fairly quick, but we get these questions all the time, and so I need to mention it to you guys, and then I'll give you some of my views. I've written here the founders strike back, but keep in mind what I said early on about, are these things really available for mortals like you and me, or are they just available for very famous people who've already formed companies that have ended up in the billion-dollar valuation range? The first one is Series FF preferred stock. And that was invented by some other law firm called Orrick and Founders Fund a couple of years ago, maybe 2007 or so. And the idea is that the founder gets, in addition to when the founder gets his or her founder's common stock, they also get this Series FF preferred stock that, if it's sold later on to investors at the time of a venture round later on, it converts into whatever stock that is at that round. Now, this is all a device to try to get liquidity for founders later on, because if you're gone to you're at Series C or Series D level, the company's been operating for 5 or 8 years. The founder wants to get some cash out. The founder says, look, I've got all this common stock, I'll sell the investors, 100,000 shares or something like that and get, make $1 million of cash right now rather than waiting for the IPO. Well, that's going to set, the investor is going to want to really want preferred stock rather than the common stock, but the founder doesn't have preferred stock. The founder probably also wants to sell at the preferred stock price, not the common stock price. But if you do that, then you've completely cooked the fair market valuation of your common stock. So we have all the issues of what are we going to grant options at later on, 409A, things like that. So this structure was invented as a way to give the founder something that he or she can sell to the investors 3 or 4 years down the road and get cash, get liquidity out at a higher valuation without causing a lot of other problems.
But it's also never been settled that the use of Series FF preferred stock and the liquidity of that comes to the founder would be treated as capital gains as opposed to ordinary income. So there's a huge question about the merit of that structure from a tax standpoint.
I couldn't have said it better, but I'll say it again. There's a huge question about whether this works. It's never been tested. When you can, from the fact that I listed that we didn't invent this, that a law firm did, we have views on it. Some of us have very strong views of it. I really question, I would not do it. It doesn't make sense to me, but I may be too conservative. Or it doesn't make sense to me that it would survive the IRS challenge. But there are some tweaks that you put in it, like avoiding vesting, to try to make it not look like stock received in terms of compensation. But it could all blow up at some point. None of these things get tested until somebody makes a lot of money off of this, and then the IRS comes looking for you. Another thing is Class F, super voting common stock. Why one has to be FF and the other Class F, I can't keep them straight. But anyway, Class F is set up so that the founders get Class F stock with 10 votes per share, whereas the normal common stock, call it Class A, gets 1 vote per share. And Adeo Resi, we talked about him earlier at the Funded. He says, every one of the companies that comes out of Founder Institute should have this structure. And the fact that Facebook, Zynga, LinkedIn, all these others have had dual class stock structures lends some credence to the fact that it, people have seen dual class stock structures before. I think that this is really one of those things that is available, not available for mortals. If you put it in, I think you're going to run into a high likelihood of getting challenged in your series at the time of your Series A. The investors are just not going to like it.
Not an IRS problem, just the investor.
Yeah. It's just voting, and there's no economic difference there.
Isn't that the classic Ford model? Ford had the 10 votes per share in the
I'm not sure about Ford, but it's a classic model among newspapers I know, and a lot of family-owned companies. All of those companies I listed up there had them when they went public. I did the IPO for Dolby Laboratories, and that was owned almost completely by Ray Dolby, and so he set up a situation like that so the Dolby family will continue to control. We're going to almost out of time right now, and I'm almost at the end of the substantive stuff I'm going to talk about. I think that the real founder protections are what they've always been, which are not great. You don't have that much more bargaining power right now, even with these new inventions, since you don't have much more bargaining power right now, these new inventions are hard to get through. So how do you try to protect yourself? Well, cut your vesting deal as best you can. Maybe get a year's upfront vesting when the investments comes in. And now I'm really talking more at the time of the Series A financing, when the first VCs come in. Try to get maybe a year's upfront vesting. Try to get protection if you're terminated without cause, maybe 6 months or a year acceleration if you're CEO. If the company's acquired and then you're terminated after that, maybe half of your unvested stock remaining or half of your total. And I think things in those ranges would probably pass muster or get through the VCs at the time of an investment. Asking for a lot more than that, the VCs will say, forget it, they'll tear it up and they'll tell you, try again. And maybe what they want is less than what I just put out there. And since the idea is to ask for something that you think is aggressive, but not so aggressive that they'll ask you to unwind it. Also, ask for board representation or somehow build into the voting agreement that you as the founder will be able to stay on the board even after you cease being CEO. As company counsel, I know ways to defeat that too, but still, it's worth trying. And then stock ownership is still the biggest thing. That's where all your power is going to come from. And that all is based on the 3 most important things in the VC financing. What are they?
Valuation.
That's right. Valuation, valuation, and valuation. So fight for valuation. And now a word from our sponsors. And since I have like 30 seconds and everyone can start leaving, again, I'm from Wilson Sonsini. What do we offer for entrepreneurs? I wanted to just tell you about a number of things that we have here. We put out a semi-annual entrepreneurs report. Doug here was the first editor and got this going in a long time. This happens to be the most recent one. I've got copies here, certainly not for everybody, but if anybody wants to take a look at these. I've also got a sign-up sheet if anybody wants to get on our mailing list to get these in the future. Be delighted to send these to you. And it tells you what are we seeing, on a quarter-by-quarter basis and up and down trends and valuations and amounts invested and terms and things like that. So we also do a life sciences report that doesn't so much talk about investment but talks about new issues in life sciences. We have an entrepreneurs college. Go to entrepreneurs.wsgr.com, and we have a whole bunch of sessions like this for entrepreneurs, and you can see there's some future ones coming up. You can sign up if you go to that website. We have a term sheet generator so that you can generate term sheets for equity deals. It's available to anybody. You don't have to be a client. We also have a thing for incorporation of documents online, same thing. This is a great website, Startup Company Lawyer, done by one of my partners, and I encourage you to have a look at it. It's got a lot of questions. It's got a really funny animation there too. And then also finally, we've just opened a collaborative workspace in South of Market for entrepreneurs to come if you need conference room space, if you need just to work on some stuff, if you want to hang out with other entrepreneurs, come by. There's the 3 lawyers staffing it. Do they look like lawyers, I'm doing something wrong. They look awful young too. So we don't even have staff there. You know, it's just those guys. So they'll be making the coffee. I may be over there later on today. That's it. Thank you very much. Went over by 2 minutes. Please come. I'm going to be talking more. I'd be delighted to have the conversation continue as long as you want to on any and all these questions. Thank you very much.